Hey folks, it's Dave Burrows. I'm on the road this week. I'm in Western Canada. I was in Winnipeg yesterday. Was fortunate enough to wake up at 3:15 this morning to catch a 5:15 flight for Calgary. And after a few meetings here today, seeing some folks, I got the opportunity to jump on with you. So I've been staying on top of markets, of course, while I'm here and talking to the team. A little bumpiness today in a couple of sectors, but thought it was important just to do at least a quick abbreviated call. So I'm going to blast through some slides here, sort of from the top down. We probably are not going to be able to do questions today, but certainly don't hesitate to reach out. As you know, we think we're in a structural bull market in equities that started in 2013. And, since January, when we exceeded the highs from 2021, we've been marching our way higher. You can see we had a brief little pullback in April, which we recouped in May. And here we are in June. So, we did make a new high in the month of May. Market was up a little over 5%, but 5.5%. We've had 2 or 3 sloppier days. Again, very minor when you look at the market cap weighted. I will say when we look at the equal weight, it's something that we're watching. Equal weight S&P was not able to make a new high in the month of May. Did not exceed the highs from April. We are trading below the 50-day moving average. And I think that that's important to recognize. We spend a lot of time looking at breadth as an indicator and the impact of different sectors. Now, what I will say is there are sectors that are performing well and there's sectors that are not performing well. It's not all about the biggest tech stocks that are driving the index. There's some big sectors that aren't behaving particularly well. So we'll talk about that kind of as we go along. We continue to see opportunity in global stocks. It's why we've been focusing a little bit on the global fund that we launched in December. Historically, once global stocks and purple started to outperform the S&P, it can go on for a while. And to show you how minimal this is so far, this is looking at the MSCI All World Index relative to the equally weighted S&P. And you can see very clearly on a relative basis, the All World Index underperformed for a very long time, 15 years. Now, it put in a low in 2021, put in a higher low in the early part of 2024. We've broken this uptrend very in a small way, something certainly to watch. As we've said, we think that once this starts, it can go on for a very long time. And so it's worth watching. In general, we have found that most investors, certainly outside our client base, have very little by the way of global exposure. The global exposure they have tends to have a significant weight in U.S. stocks. And we all lots of U.S. stocks because, of course, technology and healthcare and the consumer have been good over a long period of time. And they've become big parts of people's portfolios. But we are watching this partly because of the makeup of the portfolio in general. All World Index has a significant weight in financials and industrials and materials and energy. So we want to sort of stay on top of that. We look at the rest of the world. Japan continues to look quite attractive, pulled back a little bit in the month of May, stronger so far in the month of June. And it's important to recognize that they've moved out of deflation for the first time in 30 years. India had a good sized pullback today on the election results. We're trading around the lows from last month. That's something that we're going to watch. But it's been marching its way higher. Certainly could correct a little bit. Political change does often cause some reevaluation of portfolios, so we want to watch that. The Euro Stoxx 50 has been trading in and around new all-time highs, having made the first new highs since 2008. The Taiwan market is acting well, partly on the strength in semiconductors in Taiwan Semi, which is probably one of the most important companies in the world. And some of the Latin American countries have been performing quite well. I will note that we exited our Mexico weight about 6 weeks ago. And there's been a little bit of turbulence around the election there. But in general, global stocks continue to behave quite well. We're really happy with how that global fund is behaving. And frankly, the Canadian stock market's been behaving pretty well too. Now, you can see the monthly bar so far on the month is down. We're trading very close to highs. We're going to continue to monitor that. We'll talk a little bit about breadth as we go along. On fixed income, We continue to think that we're in a bond bear market. Yields are making higher highs and higher lows. When we look at the TLT, at the worst point, it was down 54% over the course of the last 4 years. We're a little bit off that low, but we're still below all of the moving averages. You can see TLT is a little bit stronger this week. That's on some of the weaker industrial data. And so we're watching that. But again, these are tiny moves, and there's a very clear downtrend in place in bond prices. And the bond return for the aggregate bond index is certainly negative on the year. On commodities, again, you can see we pulled back a little bit so far this month. I want to keep everything in perspective, right? Today was a down day for copper. It was a down day for gold. I think it was down about 1%, down day for energy. But to keep it in perspective, we had the first leg higher off 2020 lows. We consolidated during the Fed tightening cycle, and we've come out the top. And, this is not going to go straight higher. We're certainly going to watch, but from a breadth perspective, things continue to be pretty attractive. Certainly bond commodities are behaving very well on a relative basis versus the aggregate bond index. And frankly, they're behaving well relative to equities. So look, I'm not going to spend tons of time focusing on process today, other than to say our job is to make sure that we own the parts of the market that matter, the parts that are contributing to gains. And that might be specific sectors, it might be specific characteristics, it might be specific geographic regions. Our job is to watch for change, and that's what moved us more toward global stocks, and frankly, more towards some Canadian stocks in a few sectors, that are performing pretty well. In the absence of leadership, we're happy to sit on our hands. And as I said last week, we had some sloppy breadth in the short-term indicators, and we want to make sure that we're not pushing on a string. The long-term indicators for the NYSE continue to be positive. Percent of stocks in uptrends has been rising. It remains in place. Percent of stocks in uptrends in Canada, same thing. Now this week, a couple of little changes. We had some improvement in the percent of stocks above the 50-day moving average. That's great. But we still have 3 short-term indicators that have come in a little bit. The percent of stocks making new highs versus new lows has dropped by about 6%. Percent of stocks with positive weekly price momentum came down about another 5% this week. And the percent of stock trading above their 150-day moving average is sitting at about 55%. What does that mean? It means that 55% of stocks are trading above their long-term moving averages, and 55% of stocks trading above their 50-day moving average, and about 55% of stocks in long-term uptrends. So about 55% of stocks are in a really nice uptrend. But it does also mean that there are things that are not. It's one of the reasons we think it's really important right now to be cherry picking and be focused in sectoral leadership, not to be in a broad-based market cap driven index. There have been times when that's a great place to be. There have also been times when it's better to be focused. We think we are in a stock picker's market, a market where being more tactical can make a big difference. And we are watching for any sign that weakness spreads. Now, last week, we talked about the fact that the percent of stocks trading above the 50-day moving average had come in. We bounced a little this week. We'll see whether we can exceed the high from the month of May. When we look at the sector work, our most important sector continues to be financials. And I put this chart up because we know when we exit a period of years where you don't make a new high, and you eventually do, it's generally the beginning of some longer term strength. Just like broad-based markets, when sectors do the same, it's really important to recognize it. We can see that from the early part of this year, month by month, we marched higher. Month of May was down a little. April, month of May up a little. We're about flat here. Actually, in the last couple of weeks, financials are behaving just fine. Relative strength continues to work its way higher for capital markets related companies. Certainly the insurance companies have continued to act really, really well. Biggest firm holding we have across the entire firm is Fairfax Financial, and it continues Now, from a leadership perspective, we have seen relative strength of financials come in. This is an equally weighted basket of industrial companies, the VIS ETF. You can see we've pulled back. I'm watching this low from back here in the early part of April. We still are making higher highs and higher lows, but it matters where you're focused. We know that the days of sales of inventory recently got to exceedingly low levels. The data is getting a little bit better for manufacturing data, but it's still around the 50% level. The aerospace and defense sector continues to have strong relative strength for obvious reasons, and we continue to really like Howmet General Dynamics, and the materials continue to be pretty good. But again, these are weekly bars. This week, they've come down a little bit, but we've only just broken out of this big range. And we had a significant march higher. Again, we're going to watch the lows from about 6 weeks ago to see if we hold. We are above all the moving averages. There's a reason why they call them cyclicals. They do move around. They don't go straight higher. And we're watching the breadth readings for metals, breadth readings for precious metals, breadth readings for the uranium companies continue to be positive, but certainly they pulled back today. But I want to keep this in perspective. Copper producers, okay, pulled back the last 3 days. Keep in mind that in the last few weeks, the copper sector is up 52%. This is not going to move straight higher. So to have 3 weeks where we've backed off a little bit, staying above all the short and long-term moving indicators, moving averages, I think continues to be quite favorable. Cameco down a little bit so far this month, but again, only just broken out of a giant range it's been in since 2007. The energy sector down a little bit today. Again, we've moved sharply higher, 30% higher from the early part of the year. We're pulling back into the rising moving averages. Again, we're going to watch these position by position. We talked last week about the fact, so far the move in energy, it's been great, but it's nothing like what you see in the long-term cycle. So we think we're early days here and we're not going straight higher. Utilities continue to be relatively strong over the course of the week. We saw them turn higher in February from a relative strength perspective. NextEra and Southern Company behaving exceedingly well. And the largest cap tech stocks continuing well, while on average, the sector is less dominant. Relative strength has been falling since the early part of the year. Now, this XLK, which is large cap tech, is better than about 77% of the stocks in the S&P over the last 52 weeks, but relative strength has been fading. And it is not being accumulated the same way. We rank accumulation from A to E, and it's ranked E currently. So there has been some distribution, more in the unprofitable tech companies and the companies that are more software related. Semiconductors continue to be really strong. Biggest tech weight we have is NVIDIA. We're not the only ones trading better than 98% of all the companies in the S&P over the course of this year so far. Also in the semiconductor world, Broadcom, actually semiconductors are now the biggest subsector in the US market, making up 13% of the S&P 500, and for good reason. Both Broadcom and NVIDIA have been remarkably strong. On the other hand, unprofitable tech continues to wane. Now the ARKK is down 14% on the year against broadly higher market for the average stock, and relative strength has made a new relative low over the past week. So from a breadth perspective, the strong continue to look good. When we look at financials, banks and insurance companies among the most broadly rallying sectors. Electric utilities has moved up and to the right. Some of the materials like forest products, precious metals and metals, all above 50%, and in capital letters, meaning breadth has been expanding. Oil service positive. We've seen some contraction in oil producers themselves. So again, we've got to treat these one by one. Also in material steel, in technology, semiconductors. So this continues to be leadership. When we move to the other end of the spectrum, a lot of consumer related sectors are weak. Leisure, food, restaurants, retail, housing, autos, all in sort of the weaker part of the curve, and healthcare in general, about 35% of stocks in uptrends, meaning 65% of stocks in downtrends, and software are below 36%, meaning lots of software stocks have been under pressure. They've been impacted, by some of the higher rates. So from a positioning standpoint, there's not a lot that's changed. We have a financial sector, which continues to be about 25% of firm holdings. We really like the dividend growth that we're seeing in the holdings that we have. They benefit from improving net interest margins. They're improving capital markets environment where there's some IPOs and M&A taking place. I think that's good. Energy is about 12%, which makes us underweight in Canada, but well overweight in the S&P. Industrials weight, as I talked about last week, we took one position off. We moved that down to 11% versus 8% for the S&P. Tech has been about static. Materials came down about 1% over the course of the week. And then the sectors we've been light on: real estate, consumer discretionary, communication services, staples, and healthcare sort of really haven't changed. So we have a little tiny bit of cash. We've got some very short-term bonds. But we think that the market probably looks pretty good going through summer. Remember, we just come through a month where the market was up over 5% and bonds were down sharply. In a month where that takes place, you're going to have rebalancing in pension funds. For the last couple of days of the month and the first couple of days of June. The other thing that you have to remember is there's a lot of folks that remember the adage, sell in May and go away. So there was going to be some distribution coming at the end of May. But we looked at some of the statistics and we see a few things. First of all, credit spreads continue to come in. No sign of credit stress. Volatility remains in the bottom end of this range, which is typically where we sit during cyclical bull markets, not bear markets, bull markets. The statistics around the presidential election years continue to support that on average, in a re-election year, we see returns around 7% between June and August, as opposed to the average for all years, about 3%. So it tends to be a seasonally strong period. And a new statistic from my friend Ryan Dietrich at Carson, all of the years where the S&P was up more than 10% at the end of May since 1950, the month of June tended to be positive about 70% of the cases, but the rest of the year up 85% of the time, an average 8.8%. So just to reiterate, some of the short-term indicators have been a little weak over the last couple of weeks. It means we're not adding any new positions. We're managing our positions one by one. The key areas of market leadership have remained pretty firm. The weak areas of the market continue to be weak, and we continue to avoid them. And dividend growth as a strategy continues to outperform high dividend stocks and certainly outperform fixed income. So we're focused as a firm in dividend growth stocks, which tend to have lower volatility, and they're the best cohort for returns in all years since 1986. So coming back to the beginning, we've only just exceeded the highs from 2021. We think that in general, we have periods of relatively low volatility in the 2 years that follow that. We're pretty comfortable with the positioning as it stands right now. Should things get weaker, should we see more sectors turn lower, we're very happy to make changes. We're very willing to go to cash if that were the case. But I think we don't want to get too wound up about a couple of days of weakness. We got to run them position by position. So I apologize, we're not going to be able to take calls this week or questions. I'll be back on with a full call next week. And I apologize for doing this webcast in between meetings, but I just wanted to make sure that we touched on some of the details of the week. So thanks very much for tuning in. We'll send out the recording. If you got questions, please don't hesitate to reach out and either by email or by phone. We'll get right back to you. Happy to have a conversation. And we appreciate you taking the time to spend Tuesday afternoons with us. Have a great day.